Hi everyone. So today we're going to be looking at intangible assets, which are non-monetary assets without a physical substance. So when I think of intangible assets, I think of MC Hammer saying, "Can't touch this." Do 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 do. Can't touch this. Okay, so intangible assets are like any other asset, can be purchased and sold. So to be an intangible asset, it has to be associated with future economic benefit, and the costs have to be able to be reliably estimated. Okay, and this is true of any asset. We expect economic benefit and the cost to be reliably estimated. Okay, so with future economic benefit, we can use a cash flow projection to see this. Now, here are some examples. So one example is a patent. So patents mean that if you own a patent, it means you can take legal action against other people producing or using your products without your permission. Okay, so a patent is something you can buy. Another one is software. So software is, well, self-explanatory. Client lists as well, so details of clients that we have so that we can contact them. That's an example of a client list, and that's something you can purchase as well. I think one of my audited entities purchased a client list for about £18 million, so they are can be worth a lot of money. Another one is brands as well. Brands can be worth billions of pounds. So a brand means that often means that the consumer is willing to pay more money for that product, or willing to pay, or people are just, there's a high demand for that product. Okay, like Nike is a premium brand. People associate that with high quality. I do as well. And probably the Nike brand is worth billions of pounds. So, intangible assets are always can be a key area of FAR because, as technology grows, there are going to be more intangible assets like computer software, new computer-based products, algorithms. So it's always an increasingly key area of focus. So what are the criteria for recognizing an intangible asset? So again, we always have to consider what are the criteria. So the first one is identifiable. An intangible asset has to be identifiable. This means it's either separable or arising as a result of contractual or legal rights. What does separable mean? It means that the item is separable from the rest of the business. Okay, so it can be purchased or sold. Like we can buy brands, can't we? We can buy and sell brands. So a brand is a separable part of the business. We don't have to sell the whole business to sell the brand. The intangible asset has to be associated, as I said before, with probable economic benefit, and the associated costs can be reliably measured. Okay, and that's why internally generated goodwill or brands are not intangible assets under IAS 38. Okay, so at single entity level, we don't treat these as intangibles assets. We expense all associated costs. And I think that's because for internally generated brands, they're not a separable part of the business, or it's difficult to say if they are, and the cost cannot be reliably estimated. So a CEO says, "We designed a brand called Bossman. I want to record it in the balance sheet 170 million because that's the related expenditure as an intangible." Okay, what do you say? Well, you say, "CEO, you cannot do that. As per IAS 38, internally generated brands cannot be treated as intangible assets. You have to expense the 170 million. Okay, so this is a common exam question that can come up. So you have to be careful about the treatment. Okay, and your CEO obviously isn't happy, and now he's no longer letting you work from home. Although this doesn't really look like Ben Affleck. This might be Ben Affleck's home, who knows? So how do we record intangible assets? Well, initially at cost on the date of acquisition, so at the date that we bought them on. You can either use the fair value model then, or the cost model. Okay, so the standard says you can use either model. So the fair value model, you'll revalue the asset at certain points in the year, and the movement in valuation is reflected in the profit and loss statement. Okay, so if you've increased your intangible asset, then you have a gain in the profit and loss statement. If it's reduced in value, then you have a loss. Okay. Now, for the fair value method, this is very rare. You very rarely use the fair value method, and that's because the company has to be able to demonstrate that there's an active market for the intangible asset, which in itself is very difficult to do. And it probably is quite inefficient to use the fair value method, because you have to appoint an expert and pay money for somebody to come and value the intangible asset. So it's very subjective as well, because an intangible asset could be very unique. They're not, softwares can be unique, etc. So for cost method model, we just do the cost minus amortization minus impairment. So it's exactly the same as for PPE. And amortization, as you probably know, is the same as depreciation, but for intangible assets. So for intangible assets with a finite useful life, we amortize them. If they have an infinite useful life, we do an annual impairment test each year. And the annual impairment test can take a lot of time to do, and I'll explain that more when I come on to goodwill. So just a bit about intangibles, really. So in the financial statements, you'll normally have a note disclosing a bit more about the movements in the intangible assets. So what are the additions in the year? What are the disposals? Okay, so try and remember the format of it. So along the top, you have the categories. Along the side, you have the costs. So you have initial costs brought plus additions minus disposals. You then have accumulated amortization. So the brought forward accumulation, amortization charge, and any reversals as a result of disposal. So I just wanted to point out that amortization is charged to the profit and loss statement. Okay. Then you have your net book value, which is the same as the carrying amount. So you have it for the current year at the top, and then the prior year in the next column. Okay. So another type of intangible asset that can arise is development costs, and we're going to explain a bit more what these mean. So, for example, drug companies, it takes years and billions of pounds to develop a drug. You have to test it on animals, you have to test it on humans, and it's a very lengthy process. Okay, and drug companies were complaining because they were spending so much money developing drugs, and although that money they were spending was hitting their profit and loss statement. So then I think maybe the standards were revised. The accountant said, okay, instead, under IAS 38, if 7 criteria are met, you can capitalize some of these costs and treat them as an intangible asset. Okay, so under very strict criteria, you can treat these as intangible assets, so the cost is not hitting your profit and loss statement and doesn't look like you're underperforming. So in very certain cases, only very strict cases, we can treat development costs as an intangible asset, and the acronym that we use to remember these is PIRATE. So the first one is probable economic benefit. So you normally look at cash flow projections to see if the revenue associated with the product is greater than the costs. Does the company have an intention to use or sell the product? Okay, so GlaxoSmithKline do have an intention to sell the product, so you'd say yes. Resources, does the company have adequate resources and resources that are available to complete the development? So in the exam question, assess whether this is true, or simply list it out. Consider if the entity is able to use or sell the intangible asset. Okay, does it have the relevant marketing personnel to sell the product? Then consider, is it technically feasible to complete the project? Does the company have the relevant skills or the relevant technology to do it? Expenditure, can the expenditure associated with the product be reliably measured? So again, I think P and E basically are general definitions of assets. Okay, so remember those two at least, and then use the PIRATE to work out the others. So in the exam question, use this acronym to work out which criteria are met. Now, obviously, you can't just capitalize all development costs. Just using the word development might have a broad meaning. So the standard specifies the costs that you can capitalize and the ones that you can't. Just to reiterate, capitalize means treating costs as an asset instead of an expense. So we say that we can capitalize development directly attributable costs to development. so costs of materials and services needed to generate the asset. Employee benefit costs associated with the asset, so I mean employee costs associated with the asset, so you can use timesheet records to assess this. Any borrowing costs, so that meet IAS 23, so you might be funding the project using loans, and any interest that meets IAS 23 criteria can be capitalized. So qualifying, IAS 23 is to do with qualifying assets, so the drugs that you're developing might be qualifying assets because it's taking a long time to develop them. We also can capitalize any amortization of patents or licenses used to generate the asset. So not just anybody can go ahead and produce a drug. You probably need a license or a permission to do so. Okay, so for specialized projects, there'll always be some barriers of entry. Not just anybody I can't just suddenly come, and even if I had the right technology, I couldn't just suddenly produce a drug and market it. Okay, there's certain rules. Okay, so I remember this, my teacher saying this is a prize winner point if you remember this. So remember, if you see amortization of patents associated with the asset, you can actually capitalize them. And any fees to register a legal right to produce the drug. Okay, so yeah. Now, any indirect expenses you can't capitalize at all. So any selling, admin, general overhead expenditure cannot be capitalized. And any operating losses or inefficiencies associated with the asset before it achieves planned performance cannot be capitalized. Okay, so obviously it will take time before the asset becomes profit making. You can't capitalize these things. Okay, staff training you can't capitalize. Any staff training associated with a drug you can't capitalize. Research costs, so research is to do with any way of gaining new knowledge and understanding. If you see the word research, you know immediately this has to be expensed. Okay, so in the exam question that you have to determine which costs can be treated as assets and which costs have to be treated as expenses. Okay, so just be careful. So one question I had, which I'd forgotten, is when do we amortize development costs? And I looked it up. It's when the asset is ready for use. Okay, so if you're developing a drug, it'll be when the drug is ready for use. And as you'd expect, you amortize the drug over the useful life of the asset. Okay. So just to summarize, intangible assets are non-monetary assets without physical substance. Their associated probable economic benefit and costs can be reliably estimated. They also have to be identifiable, and this means that they're either separable or arising as a result of contractual legal rights. So we don't capitalize internally generated assets in single entity financial statements. Okay. Development costs must be directly attributable to the development of the product. So any raw materials that we need, any services that we need, any patents, amortization of patents is what I remember, any employment costs. We don't capitalize indirect costs like staff training or general overheads. For pirate, use the pirate to work out whether the criteria for capitalization have been met, and we amortize the development cost when the asset has been developed. Fair value model is very rarely used. It's only used when you can demonstrate that an active market exists for the intangible asset. And you can imagine there'll be a lot of time invested into doing that because you'd need to appoint an external valuer to value intangible, because it's very, intangible asset can be bespoke. Cost model is the obviously more common one. That's cost minus amortization minus impairment. If there's a finite useful life, we amortize. If the useful life is indefinite, so I'm just going to cross this word out and I'm going to put indefinite, then you conduct an annual impairment test. Okay, and the annual impairment test I've audited before, so we use it for intangibles like goodwill, which are supposed to have an indefinite useful life. Can be a very long and extensive test. And in another lecture, I'll be covering how to measure impairment. Okay, so I hope that was useful, everybody, and look forward to speaking soon. Cheers. Bye.